Welcome back everyone to the Audacious Witch channel where we talk about the magic behind the stock market. 5 converging trends are hampering economic growth, making recession later this year hard to avoid. 5 pivotal economic considerations: monetary conditions, U.S. fiscal policy, debt overhang, tariffs, and demographics are converging to significantly weaken economic activity this year and possibly the first half of 2026. Recession risks are much greater this year. They are much greater than they're generally recognized. These 5 divergent factors suggest the economy will weaken first, and the transition to meaningful recovery will not be quick and smooth. Business conditions will be subpar, if not recessionary. While higher tariffs may temporarily raise prices on micro basis, the unfolding deflationary trend should continue since monetary conditions are significantly restrictive. On top of these 5 risk factors, the liquidity front is number 6. What we see is liquidity stalling near term. There's a big risk that, let's say, the liquidity runs out about the middle of this year, but I think we're beginning to see the first signs of that already. Risk number 7, when you have the kind of historic refinancing demand that we are currently having here for 2025, you need a significant acceleration in global liquidity to prevent what we call a global refinancing air pocket. So that was the risk. We have went down 8% since February. This sell-off can go down another 2% or 20% or even 50%. It could, any of those things could happen, and what you do have to be sure that you're set up as such, where so nothing potentially happens can really hurt you. In other words, what hurts investors the most are the big hits that they weren't expecting. Something big that comes along fast or it keeps on going. Let's say we're already in a 2-year bear market. We just don't know that right now. I'm not saying we are, but if we are, and they just keep on chipping away at your account, what are you going to do? People are very highly exposed to stocks right now, the most I've ever seen, really. So is there anything fundamentally changes that is going to affect that risk reward? You bet there is. Gold breaks above 3,000 is signaling 2 things. Number 1, I think the rest of the world does not want to own the dollar any longer. Number 2, something big is coming to the financial market and the smart money is prepared. In the latter part of this year and then next year, the inflation rate could go back up again. We felt all along it's going to average for the next decade. It's probably going to average 3.5% or 4% on average. That means sometimes you'll have it at 5 or 6 inflation. If that happens again, that will be the next phase of inflationary crash in the stock market. There's one economic indicator that works 99% on all of the successful stock market recoveries have in common. Each of these home building stocks are performing well. Now, you might be wondering why we're talking about home building stocks. This is one of the few secret formulas that exist in financial markets. Home building companies are closely tied to the activity in the housing market, and this is a part of the economy that is extremely sensitive to the economic cycle and can provide us with accurate predictions of what to expect next from the economy. If home building activity is declining, it suggests there is less demand for homes. Buying a home is one of the most important spending decisions of people's lives. If there is reduced demand for homes, it increases the odds that people are going to be pulling back on spending elsewhere in their lives. After all, if they're not able to save up for a home, they're probably not going to be increasing their spending in other areas. That's why home building stocks are such a powerful tool to understand if we're experiencing underlying economic strength or weaknesses. The famous investor Stanley Druckenmiller notoriously uses home building stocks as a market forecasting tool. So what's the home builders ETF telling us right now? Unfortunately, home building stocks today have been underperforming, at least for now. In fact, home building stocks have been underperforming since about September of 2024. Warning, this entire time of economic weakness is long lasting and it could get much worse before it gets better. Let me give you some easy examples. If you watched my last video about Nike, Nike as a company is in decline. Revenue growth is going to be negative double digits. Factor in inflation, it is free falling. Estee Lauder and PepsiCo's revenue is declining too. Not as dramatic as Nike, but Celsius, though, just has 2 consecutive quarter of sales free fall. McDonald's, Ulta, and Target's latest quarter revenue is negative growth as well. Starbucks revenue has been free falling for more than one whole year. Best Buy's revenue has been declining for not just one, not just two, but 3 years straight. Wow, you do the math. Right?